to accountancy class. We are discussing here different concepts of accounting, of which in the last video we have finished first two accounting concepts. They are business entity concepts and second one is money measurement concepts. There are many accounting concepts which normally followed during the process of accounting at the time of recording the transactions as well as preparing financial statement. So many accounting principles are followed. Those principles are called accounting concepts, right? They are the general guidelines or fundamental ideas or maybe some rules regulations generally accepted by accounting professionals and adopted during the process of accounting only. So we finished already two. Before going to the third accounting concept, we recall first two. Number one is business entity concepts. According to these concepts, everything in the business organizations will be recorded from the point of view of the business organization, not from the point of view of the owner. Right? All the things, creditors, debtors, capital, assets, liabilities, revenues, profit, loss, everything will be considered as well as the calculated from the point of view of the business only, not from the point of view of the owner. Right? So that is why in every organization, while preparing accounting, we have to follow the concept of there is a separation between the management as well as the owners of the organizations. So, management perspective, if accounting transactions are done in the organization, then following of business entity concept. And the second one is money measurement concept. According to this concept, if the transaction has monetary values or if the transaction is able to get the monetary value, then only the transactions are called as monetary transactions and same will be recorded in the books of account and considered for the calculation of profit is called money measurement concept. In the last class I told you a few examples of non-monetary transaction which is not recorded and according to the money measurement concept. For example, appointment of an employee or resignation of manager, disputes between any employees of the organizations, right? Or maybe fixing of prices, right? So giving an advertisement. So these are the normal transactions which could not be recorded in the books of account because for them fixing money is impossible, not possible to fix the money for some transactions. That is why will not be taken place in the books of account according to money measurement concept. So now I'll go for third accounting concept, that is going concern concept. The third concept will be here, going concern concept. So what the going concern concept says means every business organization will be promoted by the promoter, started by the promoter. He gives ideas to generate the business, to start the business. Later, according to the law only, according to the act only, the business will be commenced and taking place of activities, taking some activities, right? So every business organization will start it, commencing the activities here with the intention of continuing that business or running that business for a more period of time or longer period of time rather than liquidating or closing the business only for a shorter period or fixed period. Right? So, as a businessman, I would start the business or run the activities or operate the activity transactions of the business as a year with the intention of always continuing that business or carrying that activities for the longer period of time, that I could say the unknown period of time or unlimited period of time. Right? The same thing should be followed in the case of accounting also. Right? Who is the person going to maintain the accounting work in the organization? he must have same concept in his mind while preparing the books of account. Means only current account situations or only current conditions of the organizations not only considered, even future situations, circumstances of the business are also analyzed, determined as well as estimated and taken into account while preparing the current year accounting works. So this is called following of going concern concept. Normally in accounting, advanced year information or next year information, right? So previous year informations, advanced outstandings, the amount which is receivable, the amount which is payable. So all those things are normally considered while preparing all the books of account. It may be the journal, ledger, or maybe balance sheet, or maybe profit and loss account. Right? So while preparing the profit and loss account, not only the current situations of the organizations considered, and also various situations or various conditions, circumstances also will be counted. That says here that businessman will start the business the same way. The accountant will record the transaction, maintaining the accounting work here with the intention of going or carrying that business for a longer period of time. Right? You should not have mindset of closing the business, or I mean, I'm going to prepare the accounting only for this year. I have to concentrate only for the current year. This mindset should not be there for the accountant. He has long vision, and based on that, preparing all other things. This is nothing but here going concern concept, right? So the business will not be or mere not will not be liquidated with a shorter period of time and continue that business or carrying that business for a longer period of time. In that mindset, the accounting is always prepared and nothing but following of going concern concept. Next, number 4 is the fourth accounting concept is accounting period concept. Accounting period concept. Okay, the key objective of preparing accounting work is accounting process is to calculate the profit as well as losses after a certain period of time. Right? So while explaining objectives of the accounting, the first objective, the key objective I told you to calculate the profit as well as losses of the business concern, and it can be shown, it can be known here only by preparing the accounting books of account or accounting activities, right? But the thing is here, the calculation of profit or loss has to be done with the inclusion of some period of time only. For example, like after few years, after 2-3 years, if you go for the calculation of profit, this is very difficult to calculate, and also it is illogical, irrelevant. Here that amount of profit or losses will be taken as a base for the decision making activities, right? So that is why intervally or regularly we have to calculate the amount of profit by considering some transactions of new period, right? And regularly it has to be shown to the different users of the company or users of the business organization. For that reason, group of transaction based on the period will be considered and going for the calculation of profit as well as the losses, right? So in that way, duration of preparing the financial statement, calculating the profit as well as losses, right? The duration time of calculating the profit as well as losses, preparing the books of account as well as closing the books of account for a specified period is called accounting period concept. Right? For example, at the end of each year, either 31st December of every year, or in case of financial year, 31st March of every year, if we decided to decided to calculate the profit as well as loss of the company, that day itself you have to go for the calculation of profit as well as you have to close the books of account on that day. Right? So preparing the accounts of books of account or various accountancy for a specified period, say for example half year or full year, or maybe from January to December, or maybe from April to March, right? So together of such a period, and those period transactions are taken for the calculation of profit as well as losses. Following of such a thing is called here accounting period concept. Right? So regularly the amount of profit has to be calculated and should be shown to the public or different users. Right? And without any specified period, if you go for the calculation of profit, you may not be getting the accurate amount of profit. Right? So for that reason, first we have to fix the opening date of transaction and also end date of transaction, and from the first day to end day, whatever the transaction has done, based on that incomes as well as expenses will be analyzed as well as calculated, and comparing those calculation of profit is nothing but that accounting period concept. As I told, some of the company will calculate taken as accounting period for half year, or some of the company if they have average medium number of transactions maybe full year 12 months of accounting period also taken for the calculation of profit, or if some of the organizations for example banking sectors, insurance sectors, they may have n number of transactions with a few span period only. So during that case, in that cases, within 3 months or 6 months only, they going to end the books of account and going for the calculation of profit as well as losses. The time duration taken for the preparation of that various books of account as well as to calculate and close the books of account is called the accounting period concept. This should be followed by every accountant in his accounting activities. This is number 4. Next, number 5 is the fifth accounting concept is cost concept. What is that? Cost concept. So what the cost concept says and what is the thing here followed in accounting code? So this is related to fixed assets of the organizations. Right? Fixed assets are the assets, economic resource or properties normally used for the operations of the business concern. Right? And as soon you purchase the fixed asset, it will be recorded in the books of account. Now whatever you purchased and should be recorded in the books of account because of monetary transactions. The same way you have to purchase the assets, various fixed assets, and immediately it should be recorded in the books of account. Right? And cost concept says here every year the cost of the asset which is recorded in the books of account must be same. Means for what price you have purchased that particular good, assets or the properties, the same price has to be given for every accounting period, books or maybe the accounting transactions. Okay, this is called cost concept. So let me take one example regarding that. For example, we purchased one vehicle. Vehicle is called in one of the asset for rupees 2 lakh. And when you purchased that, it should be recorded in the books of account. Maybe in vehicles account or any account, right? So where actually the vehicle account or vehicle transaction takes place, there we have to record properly and with the cost of rupees 2 lakh, right? Once the end of the year comes, you have to close the books of account, right? And whatever the assets you have taken for the next year, and at the end of second year, it has to be recorded in the books of account again, but not with the market value of that asset. It is with the historical cost. Historical cost means here for what price you purchased that goods, that is called original cost. The original cost only will be fixed for the vehicle while recording in the consecutive year of books of account, consecutive books of account, right? So this is called cost. Actually, there is a opposition for maintaining cost concept, because once the asset used, year by year the value of the asset either be decreased, or in case of some reason maybe increases due to sudden increase in the market value of the asset. There is a chance of increasing the value of asset also, but ignoring something irrespective of increasing or decreasing, we will ignore such increase or decrease of the value of the fixed asset, still maintaining or writing the original cost of the asset in the every books of account for the same asset is called cost concept. Why we have opposition is called, because every year there is a more chance of increasing or decreasing the value of the asset, right? So once we've given here that original cost only for the every year, maybe the amount of profit or loss what we are going to be calculated, it may called inaccurate amount of profit, right? So it may lead to that, but still we have a policy, we have an accounting concept that here every year for the fixed asset supposed to write the same value, that for what price that at the beginning we purchased, and that should be included that the cost of installation, cost of transportation, cost of acquisition, etc. So include including all those things, the prices of the fixed asset will be considered and will be taken or fixed for every year's books of account. That is called cost concept. Next concept is number 6 is dual concept. Number 5 is dual concept. So what is the dual concept? Actually, dual concept is very important concept which is to be followed in every moment of the accounting work, right? So that is dual concept. What it says means, I told you each and every transactions, monetary transactions will be recorded in the books of account, right? The thing is, every transaction has twofold effects. Twofold effects means, one is receiving some value, receiving of some benefit, and another one is giving of some benefits, right? So if any transaction contains exchange of something between the person, then only called monetary transactions, right? In order to receive anything from the point of a business, to receive anything, we have to give something, right? Without giving something, if you receive that, that should not be called monetary, right? It will be at the free of cost. So free of cost will not be the monetary transaction, and moreover for free of cost it is impossible to fix the prices also. The thing is here, to call any activity as a transaction, there should be something given and there should be something taken, right? So the thing is here, every transaction has twofold effects. One is giving of some benefit and taking of some benefit, right? So these two things are always included in any transaction called twofold effects, right? Which is connected to dual aspect. Dual aspect means, according to this concept, both the benefit given and the benefit received, both should be recorded in the respective or proper books of account according to dual aspect concept. The name itself says here dual. Dual means two, right? So what are the two effects of each and every transaction? At the same time, simultaneously, it should be taken place in the various books of account, normally in two books of account, that is called dual concept. If you miss in any books of account, that would not be called in monetary transactions. Still it is called monetary transaction. If you missed means, that is errors committed in the books of account maybe. So that is why in every transaction, while recording the books of account, for every transaction it is recording the books of account, dual concept has to be followed. And normally dual concept is also under the thing of accounting equation. For every transaction, accounting equation has to be followed. The accounting equation is called Assets is equal to liabilities plus capital, right? What are the properties or assets owned by the business concern? It should be equivalent to the total of liabilities as well as the capital, right? So something which is owned, it is out of owner's money or maybe out of outsiders' money, because business organization is an artificial person. Business itself owing something is not possible. So that is why business will own something that is out of owner's capital or maybe out of the liabilities of the outside parties or maybe the outside money only. So that is why for every transaction or in every transaction we supposed to follow the accounting equation, right hand side as well as the left hand side, right? So following of these equations in every transaction is nothing but dual concept, which is very important and need to be followed in every situations of the accounting. And next, revenue recognition. Revenue recognition concept. The seventh concept, which is under the concepts of accounting, is called revenue recognition concept, or it is also called revenue realization concept. So, what is called here revenue recognition concept? This is very important actually. Realization or recognition means when the transaction is done, and as per the rule of that, something has to be given as well as the received, right? And there is no compulsion the both things to be done in the organizations at a time, right? There should be in the transaction something given as well as the received, but not compulsory, or there is no mandatory case here. Both should be given as well as taken at the same time, because of credit transactions also will be taken into account, right? So according to revenue recognition concept, once the transaction has been done, irrespective of, or if there is no payment or receipt done also, that the transactions will be taken valid place in the books of account, and that is considered as that day's transaction only, not the future day transaction. Okay, following such a thing is also very important in accounting, and those called revenue recognition concept. Okay, let me explain that to you understand better actually. For example, one transaction, the business sold goods to Mr. A for rupees 20,000. This is one of the monetary transactions. That in accounting, this will be considered as one of the transaction and need to be recorded in the books of account, because there is an exchange of money in the transaction. Right? So what is the transaction? Sold goods to Mr. A for rupees 20,000. Right? So here the business sold goods to rupees 20,000. Right? The amount of goods sold here is 20,000. The amount normally receivable, the amount need to receive by the company called here 20,000. So it means 20,000 amount of goods goes out from the organization, and the amount of 20,000 cash of 20,000 will be comes to the organization. This is called dual aspect. Something given and same value benefit received taken. This is called dual concept. But here one thing is, this is in a credit transactions. Credit transactions, right? The goods sold, but you have not received any amount of cash or money against that. Right? It means we have that options. The payment also can be deferred in future according to the cash transaction rule. Right? But the thing is, goods has been sold, but amount is not received. Maybe for the accountant, one confusion maybe arises that whether they have to record the transaction now or after or at the time of receiving the payment. These two confusions maybe arises for the accountant while preparing or by recording this transaction in the books of account. But maybe you may be recorded generally not connected to accountancy. If I said to you to maintain the things, maybe you might be recorded these transactions once you receive the payment. Until unless you may treat it as in treated here is a unsuccessful transactions, right? Because I told you there should be receipt and payment of money should be in the organizations or in the transactions. But according to revenue recognition or maybe the realization concept, once the goods has been sold, even though amount is not received, the transaction should be recorded on the date when the goods are sold in the books of account. This is nothing but revenue recognition or with the realization concept. You have to record in the books of account like the amount you already received. Right? Practically, you may receive the amount of money on exact after 15 days or 1 month only, but you have to think in your mind and consider, treat the amount we already received and will be recorded in the books of account. But another side, you must have another thinking that I have to receive the amount of money after 15 days or 1 month only. So, according to accountancy, according to this revenue recognition concept, right, the revenue has come to the organization not on the date of amount you received, the date when you goods sold here to Mr. X or Mr. Y. Right? This is nothing but a revenue recognition in case of goods sold. Okay, this is called your number 7. Next, number 8 is matching the concept. Number 8 is matching concept. So what is called matching? It says matching. While explaining in the last session during the basic terms of accounting, I explained you what are revenues and what are expenses. Right? Expenses are the excess of expenses, or expenses are the amount spent on the normal operations of the business, and the revenue is nothing but the amount of money you earned on the process of providing the service as well as the producing the goods. Right? So the amount you received and amount you spent called expense as well as the revenues. Right? And same way I also explained you profit as well as the losses. Profit means excess of income over expenses, and losses means excess of expenses over incomes. Right? So means to calculate the profit or losses at the end of the year, the two things has to be matched. Compared, those two are called, one is revenues and second one is expenses. So according to matching concept, to calculate the result of the organization, to judge the result of the organization, the two things of the organization has to be compared. What are the things we recorded till now or till the date of calculation, right? So they are nothing but revenues as well as the expenses. Right? That is why I told you after recording it is compulsory to analyze as well as the summarized. Right? The summary of revenues and summary of expenses will both compared as well as matched to calculate the result of the organization, that is maybe the profit as well as the losses. According to matching concept only we have to go for. Actually this concept will be adopted or will be followed at the time of calculating the profit only. It is at the time of closing the books of account called eighth concept of the accounting. Okay, so these are the concepts we studied in this session, and there are some remaining concepts also. So we will see other concepts in the next class, and thank you.